What are the items of account that IAS 36 impairment of assets apply to? One, we talk about PPE, property, plant and equipment. That is governed by IAS 16. Another one is intangible assets. Intangible assets. And this is covered by IAS 38. Another one is goodwill. Goodwill is also covered. Goodwill is also, IAS 36 impairment of assets also applies to goodwill. You know goodwill. When you purchase, acquire a company, for instance, you look at the net assets, the value of the net assets, the fair value of the net assets acquired. Why did you pay above that amount? It means there's something that you have seen regarding their potential to generate profit in the future. That's why you are paying above the fair value of the net realizable assets. So that difference is a goodwill. Now let's see what IAS 36 does not apply to. Before we do that, there's also investment property. Now, having looked at what IAS 36 impairment of assets, that's having looked at what they apply to, which we said is made up of PPE, that's PPE, IAS 16, intangible assets, IAS 38, goodwill, and investment property. Let's look at what IAS 36 does not apply to. Okay, IAS 36 does not apply to inventory. IAS 2 covers, that's inventory. So IAS 36 does not apply to inventory, okay? Also, deferred tax assets. Does not cover it. Also, it does not cover financial instruments. This one is under the purview of IFRS 9. It does not cover financial instruments. And also, it does not cover biological assets. Biological assets. So this one is covered by IAS 41. Okay, we're going to look at key definitions of IAS 36. The key definition that I want us to look at here is, let's look at recoverable amount. This is very key for you to know. Recoverable value or amount. It is very important that you know this definition. Now, what is recoverable amount? The recoverable amount is the higher of two things. Two things. So here we say fair value less cost of disposal. Fair value less cost of disposal, or some will say fair value less cost to sell. Fair value less cost of disposal, or fair value less cost to sell. Others will simply say net selling price. Some will say net selling price. This is also correct. So there are three things that you can meet while studying. Fair value less cost of disposal, fair value less cost to sell. They mean the same thing. And you can also get net selling price. The net selling price is when you get the fair value less the cost to sell it. When you remove that cost to sell it, it becomes your net. So it's the net selling price. Good. Then the second side, on the other hand, you also have what we call value in use. So we're looking at higher of these two. So this is what the recoverable amount is. The recoverable value or the recoverable amount is the higher of two things. The fair value less cost to sell, fair value less cost of disposal, and the value in use. Now I want to explain clearly what the two of this, what it means. The fair value, we know what the fair value is. The fair value of an asset is the price received to sell an asset or paid to transfer a liability. In an open transaction, isn't it? We call it arm's length transaction between market participants, okay? Knowledgeable market participants at the transaction date. So usually that is what we say a fair value is. So everybody is knowledgeable in the market and it is done at arm's length. So when you say the fair value less cost to sell, the cost to sell, after getting the fair value of the asset, you less the cost to sell it. There could be other related costs incidental to selling that asset, to disposing that asset. Like it could be advertisement. There could be some form of transportation that is very necessary to deliver that asset to the place where it will be sold. If it is incidental to disposal, then it has to be removed. So fair value less cost to sell will be calculated on one hand. Then on this side, we are looking at the present value of future cash flows. Future cash flows, okay? Present value of future cash flows. So this is what we mean by value in use. Let me explain this very briefly so that you understand what it means. Now, if you take an asset and you look at the cash flows that are expected to recoup that asset, next year you are looking at maybe your cash flow of $2 million. The subsequent year you are looking at, maybe you have year 1, you have 2, you have 3. This year you are expecting cash flow of 2M. Maybe here you are expecting cash flow of 3M. And maybe here you are expecting cash flow of 2M. Now, these are cash flows. These cash flows will be discounted because they are cash flows in the future. So you have to discount them to present value. And how do you discount to present value? You say the cash flow all over 1 plus R raised to power N. So it means you have to know the number of years. I don't want us to go so deeply into this so that we don't get confused with what we're learning. So at this point, we're looking at recoverable amount, which you say is a higher of two things. Please note this carefully, especially for example purposes and in practice. It is a higher of two things: fair value less cost of disposal and value in use. Don't mix it up with lower of. Lower of is when you are looking at IAS 2 inventory. That is when you say the lower of costs and net realizable value. For impairment IAS 36, you are looking at the higher of fair value less cost of disposal and the value in use. I'm going to do a practical example, so we are very happy with how to calculate our value in use. Most times in the exam, you are given these figures. You are given the fair value less cost to sell, and you are also given the value in use. But sometimes you are not given. That's why I'm taking time to explain so that you know what is the value in use. Having looked at that key definition, I just want to also look at carrying value. Carrying value. Carrying value is not unknown to any accountant. That is the net book value. This is a very, very familiar term. So if you look at the historical costs, the historical cost of an asset, less the accumulated depreciation, this is what gives us the carrying value, or what we call the net book value. But I want us to stick to IFRS terminology, so we say carrying value or carrying amount, not net book value, but they mean the same thing. So this is also another very important definition that I want us to stick to. Now, having looked at it, so we've looked at two. We've looked at the recoverable amount, and we've also defined the carrying value, which I said is already known to everybody. Good. Now, having known these two terminology, the next step for us, I want us to go step by step. The first thing we are required to do by IAS 36 is to check whether there are indications for impairment. You have to check, is there an indication that an asset has been impaired? If there are indications that an asset is impaired, then you have to test for impairment. Okay, then you have to go ahead. So what are the indications? We have external indicators and we have internal indicators. So indicators of impairment. Let's look at this. We begin with the external. Good. Now, the first one I want us to look at, external indicators. Market value decline. Market value decline. What does this mean? When you look at the market value of any asset, and you see that the market value is on the low, is going down, is declining, is decreasing, then that is an indication that the asset could be impaired. It means you have to test for impairment. Once you see this indicator, you go ahead to test for impairment. So this is one of them. Another one is economic downturn. Economic downturn. So if you observe that in the economy, in the country in which you live, you operate your business, you discover that there is an economic downturn. It might not just be in that country, it could be a global situation where we have recession or we have inflation. You just generally observe that there is an economic downturn, then you have to go and test for impairment. That is an indication that the asset may be impaired. So you go and test for impairment. Another one is increase in interest rates. Increase in interest rates. So this is self-explanatory. Once you see that the interest rate in the country, usually reviewed by the central bank of that country, if you see that there's an increase in the interest rate, consistent increase in interest rate, then it is an indication that your asset, you may be carrying it at the wrong amount. So it means that asset may be impaired and you have to go ahead to actually test for impairment. And then the last one is technological obsolescence. So we say technological obsolescence. Obsolescence. Good. Now, what do we mean by this? Obsolescence is a situation where the asset you are using has been replaced by new technology. New technology has produced other assets, other machines, so that people no longer look to your machine because they have found a machine that is faster, more efficient, and perhaps even more economical. Most of those machines they could be cheaper and then they could be more efficient. So if there's a new machine that can do something, that can produce something 10 times faster, or produce more quantity and all of that at a lower cost, people will abandon the old machine and go for the new machine. And that old machine will now become obsolete. With time, nobody will want to use it at all. So it might be brand new, but nobody needs it. So the price will drop very, very seriously. So these are all indications of, these are all external indications of impairment. So when you observe one or all of this, you have to go and test for impairment. So these are external indicators. Now let's look at internal indicators. Let's look at internal indicators. Now, internal indicators, we'll look at one, we'll look at something physical damage. Physical damage is an internal indicator of impairment. You have a PPE, you have an item of PPE, you have a machine, for instance, and the machine just fell down and there's a breakage. There's a breakage. So that breakage has brought about physical damage. Once there's physical damage to an asset, you have to test that asset for impairment. It is an indication that that asset may not be worth what it's supposed to be worth anymore. The second one that I want us to look at is poor performance. Poor performance. Maybe you have a machine that is known to produce like 1,000 or let's say 20,000 blocks. It's a machine that makes blocks and it's supposed to make like 20,000 blocks in a day. And all it can do right now is just 5,000. That means the performance is poor, and that is an indication that that machine could be impaired. So you have to go ahead and actually test for impairment. The next internal indicator is plans to discontinue. Plans to discontinue. Good. This plans to discontinue is also very important. If there's a plan to discontinue the use of an asset, you have to go and test for impairment. It's that is straightforward and very, very clear. So plans to discontinue operations, you have to test for impairment. Another one is asset idle. Asset idle. So if an asset is idle, you have not been using the asset. The asset is just lying idle and it's not being used. There could be rust. There could be so many things happening to the asset because the asset is idle. An idle asset is not working the way it was meant to be. So there could be rust. There could be so many malfunctions. It is not exercising itself. So the lubrication it needs and all of that may not be working properly. So in that situation, you may need to go and test for impairment. That is also an internal indication that the asset may be impaired. So we have looked at all these indicators of impairment. We have looked at the external indicators of impairment, and we have looked at the external, we have looked at the internal. Now we are going to move on to look at something else. Now, I want to say something about goodwill and other intangibles. Now, when you have goodwill and other intangibles with indefinite life. Now, when you have goodwill and other intangibles with indefinite life, you don't wait to get an internal or external indicator of impairment. No. The rule IAS 36 requires that you test annually for impairment. You don't need to get an indicator that the asset is impaired. You don't need an indicator for goodwill and other intangibles that have indefinite lifespan. Annually, every year you have to test for impairment. We say the carrying amount is the cost less accumulated depreciation, isn't it? Now let's say a machine costs, so we say machine equals 10 million. $10 million. Okay? The accumulated depreciation is equal to 3 million. 3 million. Now, the carrying amount is simply 10 minus 3, which will give us 7 million. So in your books, ordinarily, this is the amount that you should be carrying. The carrying amount is 7 million. So if the accumulated depreciation, you have depreciation for each year, depending on the method of depreciation that you are using. If you are using the straight line method, for instance, which is very, very popular, you'll be having equal depreciation figure for every year. So maybe year 1, you're having 1 million, year 2, another 1 million, year 3, you have another 1 million, giving us for 3 years, you're having accumulated depreciation of 3 million. So by the time you less 3 million from 10 million, which is the historical cost of that asset, you are left with 7 million. So this is our carrying amount. Good. So this is our step 2. We say step 1, what do? We check. Step 1 is to check whether the asset is impaired. Okay? Step 1 is checking for indicators, external and internal indicators of impairment, which we have explained robustly. Step 2 is to come and calculate the carrying amount of the asset, which we have also demonstrated. So this is step 2. Now step 3 is to calculate so we say step 3. Step 3, you determine the recoverable amount. Step 3, determine the recoverable amount. Let's look at an example. Fair value less cost to sell of an asset. Fair value less cost of sale of an asset. You say fair value less costs of disposal is equal to 5.5 M. 5.5 M. Next, we have value in use. Value in use is equal to what? 6 million. $6 million. Now, what do you do? To get the recoverable amount, we said is the higher of the two. So we're looking at, we'll say higher of 5.5 M and 6 M. So these two, which is higher? You can see that 6 million is higher. So 6 million is higher. So 6 million becomes our recoverable amount. So this is straightforward. Recoverable amount, you are looking at the higher of two things. Value in use, fair value, less cost of disposal. So if you in this example, we have 5.5 and we have 6 million. And 6 million is definitely greater than 5.5. It's definitely higher than 5.5. So automatically, $6 million becomes our recoverable amount. That is step 3. Let's go to step 4. Step 4. Step 4 is to compare and recognize impairment. You compare and recognize impairment. Step 4, compare carrying amount versus recoverable amount. So recoverable amount is 6 million from what we calculated. What did we get for carrying amount? Our carrying amount, we said, was 7 million. 7 million. If you recall, we calculated the carrying amount. The cost was 10 million and the accumulated depreciation was 3 million. So we say the difference gave us 7 million. So now we have carrying amount at 7 million and we have recoverable amount as 6 million. So we are now going to check this. 7 million and 6 million, which is higher? 7 million is higher. So when you say carrying amount less recoverable amount, you now have 1 million. This is our impairment. So we say impairment is equal to $1 million. Now, we are able to say we have an impairment of $1 million because the carrying amount of 7 million is more than the recoverable amount of 6 million. What if it was the other way around? What if we had carrying amount to be 6 million and the recoverable amount to be 7 million? We would have gotten the same one, but it would have been a negative. Now, if it is a negative, it means you don't have an impairment. This is very, very important. It means there is no impairment. We call this an impairment loss. Impairment loss. But we do not call the reversal when there is a difference. If it were the other way around, we don't call it an impairment gain. No. Rather, we say there is no impairment. The asset is not impaired. The asset is not impaired. It doesn't mean that we have an impairment loss. Good. Now let's go ahead. What are the journal entries? The journal entries are simple. You know that all assets take debit. All expenses also take debit. But if you have an asset, this is your asset. This is the debit and the credit. Now, if this is your asset, you know that as long as the asset is increasing, you will be adding to it. You bought more asset, you add to it. You bought more, you add to it. But what if the asset reduces? What if you dispose the asset? you don't add to it. Rather, there's a reduction in that asset, so it becomes a credit. So in this case, we have a reduction in the asset. So we say we have to credit the asset. And then the impairment loss is an expense which is treated in the P&L. So our journal entry is simple. We say we debit impairment. We debit impairment loss. That is P or L, isn't it? With how much? 1 million. And also we credit the asset. What is the asset? A machine. We credit the asset with how much? 1 million. So the double entry is now, so we say being impairment loss, now expense in POL. So this is how we do our journal entry. I just did the ledger just to show that if you have a rock solid knowledge of T accounts, where we say all assets take debit, all expenses take debit, all drawings take debit, and all incomes, all liabilities, and capital take credit, you might be confused, especially if you're a beginner, wondering why we are crediting the asset. We are crediting the asset because the asset is not increasing, but it's rather reducing. So when there's a reduction in an asset, then you have to do the credits. Good. Now let's move on to step 4. Okay, we've looked at that, but before that, I just want us to look at what value in use means. This is very, very important. What is value in use? Value in use is the present value of future cash flows, which I've explained. So what do we need to get the value in use? We need the estimated future cash flows or inflows, as the case may be. We need it. We need the estimated useful life, and we need the appropriate discount rate. And of course, we need the discounted cash flows to present value. So we discount the cash flows to present value. Next, I want us to look at something that's very, very important in IAS 36. And that is what we call CGU. That is cash generating unit. Cash generating unit. This is very, very important. Sometimes an asset does not generate independent cash flows. Okay? For example, we have a production line inside a factory. When you have a production line inside a factory, it does not generate cash flows independent of other assets. So where it does not generate independent cash flows, then it means it is a CGU. So we say the CGU is the smallest group of assets generating independent cash flows. The smallest group of assets generating independent cash flows. So when that happens, we have to test impairment at the CGU level. Now let's demonstrate this with an example. But before we go ahead, I want us to know that it is very important for goodwill. It is very important for large production systems, and it's also very important for retail branches. So step 6, we're going to look at impairment of goodwill. How do we treat impairment of goodwill? Goodwill cannot be tested individually. We can't test goodwill individually like we do for other assets. It must be allocated a CGU. And when this happens, it will be tested with other, that is the CGU, with other assets that, the smallest group of assets that generate independent cash flows. So that is how we test goodwill and other intangible assets with indefinite life. Now, when this happens, you look at the carrying amount of the CGU. You also look at the recoverable amount of the CGU. Now, if the carrying amount is more than the recoverable amount, then it means the asset has been impaired. It means we have an impairment loss. When that happens, we treat this specially. Goodwill is a special kid in the CGU. Goodwill has to be removed in full. Then the balance will now be prorated among the other assets. For the CGU, I want to reiterate, for the CGU, once you calculate the impairment loss, you remove the total of goodwill from the impairment loss in the CGU. The balance that is now used to be shared to the other assets on pro rata basis. Good. Now, let's look at an example to illustrate. A CGU. A CGU has carrying amount, CGU, cash generating unit, carrying amount, equal to 20M. 20M in dollars, $20 million. We also have the recoverable amount equal to how much? Equal to 50 million. What does this tell us? This means that when you look at the recoverable, when you look at the carrying amount, 20 million, and the recoverable amount to be 15, it shows that this asset has been impaired. If the carrying amount were to be 15 and the recoverable amount were to be 20, we will say there is no impairment. But as long as the carrying amount is higher than the recoverable amount, we say that asset has been impaired. And the impairment is to the tune of how much? 20 minus 15, which is 5. So we say impairment loss is equal to $5 million. This is our impairment loss. Now let's assume that we have the value for goodwill. Goodwill is worth how much? Let's say 3 million. But we say but goodwill is equal to 3 million. So what do? It means this 3 million will be removed from 5 million impairment loss. You have to remove goodwill as a whole. You remove the goodwill immediately. So when you remove goodwill, so this will now give us 3. So we'll say 3. When you remove 3, what do you have? You have 2. So you say balance of impairment is now 2. Now, this 2 million is what will be divided among the other assets, having removed goodwill as a whole. So goodwill is now 0. There is no goodwill at all because we have removed, the goodwill has been completely impaired to the tune of 3 million. So the other assets that make up the CGU will now share this impairment loss of 2 million. Now, let's go ahead to see. After that, we'll look at another practical example. But before we do that, I want us to look at a situation where there is reversal of impairment. Now, when an asset is impaired, it means that asset is not worth what we're carrying it in our books. The essence of this is to make sure that we do not carry assets above their recoverable amount in our books. That is the essence of impairment. That is the essence of IAS 36. To ensure that every asset is not carried above their recoverable amount, such that you'll be carrying an asset for 50 million, but when you go to sell the asset is actually worth much, much less. So we don't want that situation. That is why we have IAS 36 to guide us on how this should be treated. That is why we have impairment loss. But sometimes an asset that has been impaired, we could have favorable conditions. We talked about economic downturn, like recession, like inflation and all that. What if the economy improves seriously and the asset now has a boost in the value of the asset? What if it receives a boost by favorable conditions? That asset, that impairment will be reversed. But there are rules for reversing impairment. The first thing is that goodwill is not reversed. We do not reverse goodwill. That is the first thing I want us to know. Secondly, when making this reversal, if 5 years ago you did an impairment loss for a machine, the carrying amount of that machine was supposed to be 50 million. That is historical cost less depreciation, accumulated depreciation. Let's say it was supposed to be 50 million. The next year, you're supposed to remove 1 million for it to be 49. Another year is supposed to be 48. So that this current year, the asset is supposed to be worth 47 million. If ordinarily this is what the asset is supposed to be worth, if there was no calculation of impairment, you were calculating your normal calculation, calculating your carrying value. costs less accumulated depreciation. If this is what it should have been, everything being equal, you cannot do a reversal of impairment to now move ahead above this amount. Let's say you now say, okay, we have favorable condition, and then you do a reversal to the point that you are getting 60 million. It is not allowed. You cannot reverse above what it would have been. You cannot reverse above this carrying amount. It is not allowed. Secondly, as I said before, you do not reverse goodwill at all. So when you do a reversal, what are the journal entries? Or the ledger entries also? Recall that we said asset. For ledger, we said you have this, all assets take debit, isn't it? And then we said this was done. So where this happens, this time around, you come to remove this, you come and debit. So you debit your assets. Also, where you are having the impairment loss, this impairment loss that was here, you will now credit it. You now credit impairment loss to remove this. So you have to reverse your entry. This is for impairment. So you have to reverse it. So the journal entry would be you debit the asset and you credit the reversal of impairment. That's P&L. You do the reversal. Next, we want to look at step 8, which is impairment under revaluation model. Impairment under revaluation model. Impairment under revaluation model. Does this sound familiar? This is from IAS 16 PPE. Remember that according to IAS 16, property, plant, and equipment, initial measurement is at cost. You measure the asset at cost, plus all other costs that are directly incidental to bringing it to its condition and location. Every directly attributable cost will be added to the initial cost. That is what gives us the cost model. So that is the first thing to do. Subsequent measurement, you have two IAS 16 allows two models. We have the first model, which is the cost model, which I've explained, and then also have the revaluation model. So we have costs model and we have revaluation model. That is IAS 16. Now, we're saying that impairment under revaluation model, we decrease first. That is OCI. We do it in OCI. Revaluation decrease first in other comprehensive income, and then the excess goes to P&L. So what it means is that revaluation, you know that revaluation loss goes to other comprehensive side of the income statement. That revaluation loss will first be decreased. The reversal starts from there. If the impairment is to be 10 in the OCI, and then what you are reversing is actually 12. It means you will first reverse 10 from OCI, then this balance of 2 will now go to P or L. Now let's look at step 9. Step 9, disclosure requirements. Disclosure requirement. What are the things to be disclosed under IAS 36? Disclosure. This is important for the exam. Disclosure requirements. IAS 36. The first one is impairment amount. Impairment amount. You must disclose the impairment loss. What is the amount of the impairment loss that you have calculated? You have to disclose in your notes to the account. Second one is reversal amount. Reversal. Is there any reversal of impairment? We have just finished explaining reversal. So where there is a reversal, you have to disclose. Next is events causing impairment. What are the events? If there are events causing impairment, those are indicators. You have to disclose. Like economic downturn, like technological obsolescence, like physical damage, all these are events that cause impairment. You have to disclose them. Then the discount rate used for value in use. You know that value in use is a very, very important part of impairment loss calculation, because we say the carrying amount less recoverable amount gives us the impairment loss. And we say the recoverable amount is a higher of fair value less cost of disposal and value in use. The higher of fair value less cost to sell and value in use. So how did you get your value in use? IFRS wants to know. They say you should disclose the value in use discount rate. Tell us the discount rate. Was it 10% you used? Was it 9%? What did you use? And of course, if I want to add, I'll say, how did you get it? So assumptions used in CGU. What are the assumptions used in CGU testing? In testing your cash generating unit, what are the assumptions that you use in testing them? So you know that there is goodwill, and then you have all of those other intangibles and some physical assets, items of PPE. So you have to also tell us what are the assumptions in use. What are assumptions used in CGU testing? CGU testing. What made you to believe that the CGU was impaired? You have to tell us. You have to disclose. Now let's look at a full practical example. A machine costs 50 million. Machine. 50 million. We're working in dollars. Accumulated depreciation is equal to 5 million. We'll say carrying amount is equal to 10. Okay. Now, we are told that the fair value less cost to sell, fair value less cost to sell or cost of disposal is equal to 7 million. And then we have value in use. Value in use is equal to 8 million. Good. Now, if you look at this, what is our recoverable amount? The recoverable amount is a higher of the fair value less cost of disposal and the value in use. So if you look at these two, which is higher? 8 million is definitely higher. So 8 million is the recoverable amount. So we say recoverable amount is equal to 8 million. Carrying amount, on the other hand, is already given as 10 million. This is carrying amount. So we'll now say carrying amount of 10 million less recoverable amount of 8 million, that will give us 2 million. So we have impairment loss. Impairment loss is equal to 2 million. And what do? We debit the impairment loss, which is an expense, and we credit the machine. All machines are assets, and all assets are supposed to take debit when they increase. But when there is a reduction, we credit the asset. So new carrying amount is now 8 million. So it means this carrying amount is no longer 10 million. New carrying amount for asset is now at 8 million. So this is how we carry the asset. We now carry this asset. The asset is reduced from 10 million to 8 million. This is what it means. Now let's look at these common exam traps that I want students to know. Note carefully. Students make the mistake of using lower off instead of higher off. When calculating the recoverable amount, they make the mistake of saying lower of fair value less costs of disposal and value in use. It is not lower off. It is higher off. I've explained that before. Lower off is when you are treating IAS 2 inventory, and it is the lower of cost and net realizable value. But for IAS 36, impairment of assets, we are looking at the higher of fair value less cost to sell and value in use. I say if you don't call it fair value less cost to sell, you can call it fair value less cost of disposal. You can also call it net selling price. These three items, these three terms are correct. So it is higher off that we are looking at when it is IAS 36. Another thing that students mix up is they forget to test goodwill annually. The rule of IAS 36 is that goodwill must be tested annually. This is not just for exam purposes, but also in real life. Goodwill must be tested annually. Number 3, they forget impairment allocation order when allocating impairments, especially in a CGU. Remember that the whole of goodwill must be removed first. It is after you have removed goodwill, then you get the balance. Then you begin to allocate. You share on pro rata basis for the other assets. When you total all the assets, if one asset is 10 naira, another one is 10. If the first asset is 10, the second one is, let's say, 20, and the third one is 30. It means you have to total this, and you have to get, this is 3 plus 3, 60. So it means the first one will be 10 over 60 multiplied by that balance after you have removed goodwill. The second one will be what? 20 over 60 multiplied by the balance. And the third one will be what? 30 over 60 multiplied by the balance of impairment. This is how you prorate. All right. Now, another one is reversing goodwill impairment. When it comes to reversal, students should remember that we don't reverse goodwill. Goodwill impairment is not reversed. You do reversal for others in the CGU. For other PPE, you can do reversal, but for goodwill, you do not reverse goodwill. So that is a common mistake that students make. Another one they do is to ignore CGU concept. The concept of CGU, cash generating unit. Don't ignore it at all. So to summarize, IAS 36 ensures that assets are not overstated. It ensures that assets are not carried at over their recoverable value. Then assets are not overstated, and there are steps we follow. The first thing is we have to identify the indicator. We have external indicators and we have internal indicators of impairment. And once you see those indicators, one or all of them, you have to go ahead and test for impairment. Next is you compute the carrying amount. The carrying amount is the historical cost of an asset less the accumulated depreciation, which we also call the net book value. But I will not advise you to use net book value. Use the terminology carrying amount. So a professional, and we're using IFRS. So stick to IFRS terminology. But remember, this historical cost less accumulated depreciation. That gives you the carrying amount or carrying value. Also, what do you do next? After getting the carrying amount, the next step, we compute recoverable amount. I've over-explained recoverable amount. The higher of two things. Fair value less cost to sell and value in use. Whichever is higher, you take. That becomes your recoverable amount. And lastly, what do? You recognize the impairment. So remember, recoverable amount is higher of fair value less cost of disposal and value in use. If you understand IAS 36, it means you have understood one of the most examinable areas of the IFRS. So if this has helped you, I want you to like, I want you to subscribe to my channel and share this video with your friends, especially if you have an accounting student, someone who is doing accounting. Share this video with them so that we can help ourselves. I remain Echela Okori, your accounting and finance coach. Bye for now.